Welcome everyone to another In Conversation with Credible. In this episode, we'll be discussing the road to home ownership. My name is Lewis and I'm part of the Credible Queensland team. I've worked in financial services for over a decade, and for the last 5 years, I've been dedicated to partnering with doctors, dentists and vets to fund their homes and investment properties. Today, I'll be your host and moderator, whilst in conversation with two of my colleagues who are experts in residential lending. For those of you who haven't dealt with Credible before, we are an independent medical financer focused on servicing the needs of doctors, dentists and vets. Being independent allows us to access multiple lenders within the market and provide tailored lending solutions. With our conversation today, please bear in mind this is general information only and we're not providing personal advice. Following the chat with my colleagues, we'll have 10 minutes allocated at the end for questions and answers, as this is an interactive conversation. You can submit your questions throughout the presentation in the live Q&A section on the right-hand side of your screen, and we'll cover off on as many of these as we can at the end. If it's not there already, you can click the button with a couple of speech bubbles and question mark to activate the panel. For any Android users, there will be a slight audio delay when you type into the Q&A section, but that audio will return. If you want to test this out, you can let me know in the chat box where you are joining us from today. So who are the two industry specialists we're hearing from? First, we'll hear from our Sydney-based lending veteran, Paul Hastings, who heads up our residential lending team and has over 15 years experience of supporting medical professionals in their home ownership journey. Then we'll move to our Melbourne team to hear from Lindsay Rose, who has a wealth of knowledge, having also been assisting medical professionals to finance their homes for over a decade. Together in today's chat, we'll expand on our Home Buyers Checklist ebook, which we designed to help you gain clarity throughout the home buying process. So let's head to Paul to tell us a little about what doctors might consider when they begin their home buying journey.
Yeah, thanks, Lewis. I don't know whether the 15 years of experience means I've experienced or just old, but thank you anyway. So it's always been the great Australian dream to own your own home, and we find that most medical professionals are also keen to buy as early as it makes sense for them. The decision and the property type and location of their first property, however, will usually be determined in conjunction with work at the forefront of their decision making. The obvious determining factor of their ability to get into the property market is their ability to pay the mortgage. So medical professionals are in the unique situation where they do have the ability to enter the property market earlier in their careers versus the general public, say, as they can take advantage of more favourable lending options, and these are based around the robust nature of their ability to earn. The timing when they choose to explore these options may be determined by the amount they're paid or the complexity of their incomes at the time. For example, a PAYG income doctor, it has a more straightforward income structure to deal with for the banks than, say, a self-employed medico who has multiple appointments and no longevity as a self-employed worker. The other timing consideration centres around the career cycles. First home buyers aren't always looking to buy in areas they consider to be their forever home. The nature of most medical jobs means at some point their work will take them to a non-metropolitan or rural area where they may look to invest in property for future investment, which is close to the place of work. It also means in the short term, it provides an owner-occupied accommodation solution in areas where they may not have, or they may have traditional shortages of short-term accommodation. So it's a win-win. Career cycle factors also feed into personal life cycle requirements, which influence the buying decision. Factors like, are they buying to accommodate a growing family? Do they have extended family that they're looking after? Or are they just buying closer to the workplace so they don't have to commute? The timing of these personal changes will determine when a first home buyer starts to explore their options. In turn, it will also largely determine the type of property they are looking to buy. For example, younger professionals looking to buy accommodation closer to metropolitan workplaces, they'll tend to look at units and townhouses, largely due to affordability factors. Dual income buyers looking for more accommodation may look at larger homes in more suburban areas. So with this desire to get in the market, obviously there's got to be the opportunity. What are the types of factors that make this opportunity a buying reality? So as we discussed, the favourable lending terms and lower deposit requirements may mean that a medical professional will have the opportunity to get in the market more quickly. The low interest rate environments like we're experiencing now means that affordability of a new purchase may be much better. Government incentive schemes, again, like we're seeing now, and also Lindsay will touch on later, can mean a purchaser has access to greater benefits or less costs in the form of stamp duty exemptions. The lending environment, what's the appetite of the banks to lend? Now for medical professionals, it's still very good. And family support, the old bank of mum and dad, they may provide the deposit needed to enter the market more quickly. So as you can see, Lewis, the timing on when the first home buyers consider getting into the market varies greatly, but certainly influenced by many factors. Back to you.
Thanks, Paul. Great information there. I'm sure we'll get lots of questions coming through. Lindsay, understanding both the terminology and costs associated with buying a home is really important for first home buyers. What are some of the key terms that doctors need to understand to get into the property market?
Hi, Lewis. Yeah, thanks for that. Just like in the medical world, within home buying, there's lots of jargon and specific terminology that we come across. So it's good to familiarize yourself with some of the acronyms we use and some of those key terms. I'll just run through a few of those. We actually do have a number of blogs and articles we've written about already, which concern a number of these terms. So if you want a little bit more clarity or want to read up on them, we're just going to drop some links into the Q&A section of the chat there, so you can follow along with those and get a little bit more in-depth insight into some of these terms. The first one I'm going to touch on is just loan to value ratio. This is LVR, as we commonly say, and it basically refers to how much you owe or borrow against your property versus the value of that property. It's generally referred to in a percentage like 80 or 90%. And this one plays directly into the next acronym I'll talk about, which is LMI, or Lender's Mortgage Insurance. Lender's Mortgage Insurance is basically an insurance that you, the borrower, pay for, but it actually protects the lender or the bank itself. So it's something you'd want to avoid if you can. We do have a little link on that one as to what LMI is. So we'll pop that one into the chat for you. It can be very expensive, and your loan to value ratio affects whether or not you actually have to pay for this. Most banks require a 20% deposit for your home, but for medical professionals, there are a number of packages available where you don't have to quite put in that much, maybe 10% or sometimes even a 5% deposit for that home purchase. So we can talk you through sort of what savings you're going to need and what that means to try and avoid that large cost of lender's mortgage insurance. The next acronym to touch on is the FOG, or First Home Owners Grant. This is one of those government incentives that Paul was mentioning. It is for first home buyers, and it is sort of to help you with the cost of getting into that first home. We've got a link for that one as well as to the most recent schemes that are available. So that's the First Home Owners Grant, as well as a new one, which is called the Home Builder Scheme. So the link in the chat will touch on a few specifics around that. These are state by state incentives, so they can vary depending on where you live, and there are specific requirements to qualify for each of them. Sometimes there's income requirements, sometimes it's the value of the property you're purchasing. All these kinds of things can affect whether or not you actually qualify for these incentives. So best to talk to somebody about what you're looking to do and whether or not your property purchase will qualify. The next one you'll want to know about is, of course, stamp duty. The government always likes to take their cut, so this is the tax that you're going to pay on your property purchase. Again, stamp duty varies from state to state, and it's typically about 5% of the property value that you're purchasing. For first home buyers, however, there are often exemptions for stamp duty. Again, a number of different factors that are going to affect whether or not you have to pay, including purchase price and things like that, and the area in which you're buying. So have a look around, talk to somebody who knows about whether or not you're going to have to pay stamp duty, because that's additional savings you need to have if you don't qualify for a waiver. In addition to those sort of acronyms and terms, you also want to know about the people who are involved in the process. The first one you come across often is just the real estate agent. So these are the people who are advertising and selling homes. In addition to real estate agents, however, there are also buyer's agents or buyer's advocates out there in the market. So while the real estate agent works on behalf of the vendor, the buyer's agent or advocate will work on behalf of the buyer. We've got a blog post for that one as well, so just check the chat and I'll give you a little bit of the difference and what the benefits to using an agent or an advocate can be. I think it's a really interesting one to consider. A lot of people don't seek professional advice on a purchase of a property, and it's funny because it's hundreds of thousands and sometimes millions of dollars that we're spending, and there are very rare instances where you wouldn't seek professional advice on a purchase that big, but because we're so used to buying homes and buying property in Australia, a lot of people just go in head first and don't actually look at those kinds of things. So an agent or an advocate can help you talk through your budget and where you want to buy and what good areas are, and also help you negotiate and help you understand the process and make sure you're getting the best deal. They can also help you organize things like building or pest inspections if you want to check that kind of stuff at the property before you're actually buying. If you don't decide to use an advocate or an agent because costs can vary and obviously sometimes it can be quite expensive, maybe just registering your interest with local real estate agents can be a good idea as well. Oftentimes they'll present you with properties that are off market or before they're really well advertised, and that can give you just a little bit of an inside track on properties you're interested in as well. Then there's also the conveyancer or solicitor. So this is basically your legal representative. It's somebody who is going to work with you on all the contract side of things and getting your paperwork in order when you're buying. I would recommend engaging that person early in the process. They can help you vet contracts of sale and read through all the legal jargon there to make sure there's nothing untoward or bad in the contract that you might not want or might not be in your favor. We've got a little blog on that one as well, so we'll pop that link in the chat for you if you want to know about engaging a solicitor or a conveyancer. And finally, the last person or institution rather is the lender. This is the bank or finance provider that's actually going to be giving you the loan. There are loads of options in the market, from the big four banks to smaller online banks or credit unions, as well as non-bank lenders. I think when you're looking around, a lot of people are comfortable with their current bank and they might just go back to where they've got their existing accounts and ask that bank for information about home loans. But as medical professionals, there are certain packages that are available to you and benefits across the market. And I think that talking to somebody who has access to a lot of those different options is really beneficial. When you speak to only one bank or one lender, you only get a feel for what they can offer you. So speaking to somebody who knows the full market around what can be offered to medical professionals is a really good idea, because there are often different interest rates, different rebates or cashback offers, and also different waivers or loan to value ratios that can be provided to you as a medical professional. I think that pretty much covers most of the lingo and the people involved when assisting with the purchase, Lewis.
Thank you, Lindsay. I think you make a great point about talking to a lender who can access the whole of the market rather than just one bank. We've seen this year completely flipped on its head with COVID, and what's actually happening is all of the banks and finance providers have actually changed their lending policies around the types of loans that they will or won't approve. So if you are talking to just one bank, not only will you only have their one product available, so you might not get the best deal, but also you might not actually fit into their new lending policy. So it is really important that if you want to put yourself in that best possible position to get your loan approved, then you should be speaking to a finance provider who does have access to multiple lenders. So Lindsay, for our doctors who now they've identified the target location they want to buy in, understanding the people involved that they need to speak to and how the market works, looking at the numbers side of things, what can doctors start doing now to get closer to achieving their home ownership goals?
Yeah, well, I think it may be a little bit obvious, but starting with the basics is really important. First thing I would talk about is just how to budget. So when you're looking at buying that first home, have a look at your regular spending. Banks do look now at your spending for the past 3 months just to get an idea of where your money actually goes. And we do take that into consideration directly when considering your borrowing capacity. So have a look at that first and foremost, and maybe for the first, sort of 3 months prior to getting that application going, keep an eye on those kinds of things and maybe cut back on any extraneous spending that you've got. That's really going to help you down the track. And another thing that I might say to consider is actually your credit card limits. A lot of people don't realize this, but if you've got overdrafts or credit card limits that you don't really use, maybe have extra limit or a lot of space in them that aren't necessary, those are basically lines of credit that you could draw up at any point in time, and that could be a debt. So the bank does have to consider that at the full limit level, not just how much you owe on your credit cards. So if you've got excess limits, maybe consider just bringing those down. It's going to help with your borrowing power as well. The next is obviously saving for your deposit. So when you're looking at that deposit and how much you're going to need to put away, you want to consider the area in which you're buying and how much you're going to need to pay for the house or apartment that you want to actually get into. That's going to dictate how much you need in your deposit. You can also talk to a finance provider about exactly how much you need to put away for that purpose. When considering your actual borrowing capacity and how much of a loan you might be approved for, I really recommend talking to a professional. We're going to take into consideration things for your borrowing capacity that you might not think of. For instance, we have guidelines that indicate benchmark interest rates. So just because interest rates are really low right now, they may not always be, and we consider rates that may rise in future, and we take that into consideration with your home loan borrowing capacity. Also, things you might not realize that you have as debts, for instance, a HECS debt or a HELP debt. If you've got that education debt, it kind of just comes out of your income and you don't really think about it, but it is an actual debt that we need to consider that you have as well. So have a chat to a professional, certainly, to get a really good idea of those numbers. If you are looking for just a really basic rule of thumb to get yourself started, I would say typically about 5 times your household income is a good place to start with what you might be approved for in a loan. That's obviously going to vary widely if you've got a few other debts like car loans or HECS debt, or if you're single versus in a relationship and buying together, or if you've got kids and things like that. So just like a pretty basic place to start. And the last thing that I would say anyone should do when you start looking for that home loan is to get a pre-approval. The importance of a pre-approval can't be understated, I think. And we've got a little blog about that one as well. So we'll pop that in the chat too, so you can have a little read through of that one. But a pre-approval is so important because it allows your circumstances to be assessed on an individual basis, and you know that when you actually go out and you're trying to make offers and look at properties, that you've got the backing of a lender. And you want to make sure it's a full approval and not just a verbal, oh yeah, somebody's run some numbers for you and about this much looks good. Having something official and in writing is really important, so definitely get that pre-approval in place. I'd say those are probably the best tips I've got for starting that process, Lewis.
Thanks, Lindsay. Some great tips there. I think all three of us, we've been doing this job for a long time, and the number one thing we still tell clients is that you have to get your finance pre-approved before you start going out there and making any offers for properties. As you said, it does give you the confidence to know exactly how much you can borrow and which properties are within your budget, but it also just puts you in a much better position to negotiate with either the sellers or the real estate agent once you do find that right property. And having your pre-approval letter with you, it just shows the sellers that you are a serious buyer. And from their point of view, it makes you much more likely to actually complete the purchase compared to someone else who might be making an offer but doesn't necessarily have a finance approval in place. And quite often that can be the deciding factor in your offer being accepted against somebody else's. Continuing on the finance side of things, we might move back to Paul in Sydney. Just to cover off on that part of the process that might get doctors a little bit nervous. Paul, can you help us make sense of the actual dollars that are required towards home ownership?
Yeah, thanks, Lewis, for sure. I mean, the most important part of taking a loan out or buying a property is being able to pay it back. Now that you've got a good idea of the first home buying landscape, expertly pointed out by Lindsay, we're going to go through what the numbers look like, what's required by you as a borrower, and things to consider when choosing a product. So we'll do this using a borrowing scenario with the following parameters. I think it's the easiest way to outline an actual scenario. So we're looking at an $800,000 purchase of a new unit, which is an important point, as we'll go through in a second, in a metropolitan postcode close to a hospital or surgery, depending on whether you're a doctor, a dentist, or a vet. The applicant is a young medical professional who is PAYG employed, so a simple income structure with a 10% deposit. So just on the deposit side, firstly, ideally lending institutions are looking for you to have 10 to 20% ideally as a deposit. That also gives you the most flexibility in terms of lending product. Of this deposit, 5% of that deposit needs to be saved as genuine savings over a 3-month period, and they'll be looking for deposits that you've made into your account over that period of time. If you've got 10% or more, there's usually a little bit of flexibility on that genuine savings piece, but ideally that's what you're looking at. So under our example, we'd be looking at an $800,000 purchase. Obviously at a 10% deposit, it's an $80,000 deposit amount. So our purchasers under our scenario have some savings that they put away themselves. They're using some family help from the bank of mum and dad, and they'll also have some benefits from the first time owners grant. And the reason why is because the property is a new property. So it's an important point to keep in mind when you're looking at, potential properties that you may want to buy. So what are the additional costs that we're looking at over and above that? So typically, if you're looking at legal or conveyancing costs, you'll be around about the $1,500 to the $2,000 mark, depending on who you're using. There's the registration costs on the property, which varies state to state, but you're looking between $300 and $500. The big one is stamp duty. So getting back to our scenario on an $800,000 purchase, and we're using New South Wales as an example, you'd be looking at $31,000 in stamp duty costs, which is huge. When you're looking at $80,000 to get together for a deposit, and then another $30,000 just in stamp duty costs, the government certainly doesn't miss you there. However, as we're buying in New South Wales, a new property up to $800,000 will get a full exemption on stamp duty. So we're saving a significant amount of money, $31,000 on the stamp duty, $10,000 as it is in New South Wales as a first time owner's grant, which is $41,000 in benefits before we start. Some of the banks are also offering rebates at the moment. They're being quite generous to get your business. So those rebates can be between $2,000 and $4,000, which you can also use towards the cost that you need to get into the property. Just be aware that some of those rebates are post-settlement, so you may not be able to rely on them for the actual settlement of the property. What do we need to provide the financial institutions as far as paperwork goes? Without being too prescriptive, because they do change from bank to bank, a typical list of paperwork requirements would be as follows. You need to evidence your income. So as a PAYG employed person, you would need to provide 2 recent payslips in most cases. If you're self-employed, 1 to 2 years tax returns, which does vary from lender to lender. ID is generally your driver's license and or a passport. And just going back to the point that Lindsay raised earlier, most banks will want to see 3 months worth of bank statements on your main transactional account. And this is to show 2 things. It'll show pay deposits if you're a PAYG employee, but it'll also show your spending pattern. And that's what they're looking at in terms of how you're spending your money. It'll also show other things, like if you've got buy now, pay later, like Zip Pay, Afterpay, those sorts of things. So as Lindsay said, you may want to consider those or changing those spending habits if you know you've got a lot of those costs coming out of your account prior to starting this whole process. Evidence of any other loans that you may have as well, the bank will want to see in statement form. So they're things like personal loans, credit cards, overdrafts, and things like that. And then the deposit evidence. So using our example, they'll want to see a bank statement to show the amount of deposit that the person saved over that period of time, some sort of a grant approval to show the money that you're putting towards it from the government benefits, and a stat deck from mum and dad to say that they're going to give you some money. So what are we considering in terms of a mortgage product? So currently, and beneficially for everybody out there, we're looking at one of the lowest rate, or the lowest rate environment that we've ever been in. So cash rates getting close to 0%. Variable rates around about 2.4 to 2.5% for an owner-occupied P&I loan, and fixed rates in the early 2s. Most banks are between sort of 2.2 to 2.4, so a super low rate environment. In the mortgage product, people are generally looking between a fixed and a variable rate option, and which one they choose is largely determined by two factors. The first is what is the fixed rates in comparison to the variable rates, so which one's obviously cheaper, and what flexibility does the borrower require in the product. So generally you get the ultimate flexibility with a variable rate product in regard to your ability to pay the loan back whenever you like. The caveat to a variable rate product is that obviously the rate can fluctuate over that period of time. Fixed rates, on the flip side, will provide a stable rate environment for the period that you choose, generally 1 to 5 years. However, they don't have the same flexibility as variable rates when it comes to the repayment of the loan at any time. So that's what the trade-off is. To get the best of both worlds, you may opt to split your loan, some portion fixed, some portion variable. And this is, I suppose, a structure that's quite common if you're looking for the best of both worlds and some ultimate flexibility. There are some lenders out there that provide extra flexibility on those fixed rates products as well, so that may be something to consider. We wanted to touch on also the option of an offset account on the home loan. It's a very common add-on to a product that most first home buyers will discuss with their financier. So I'm just going to read a little bit about it because it is a little bit tedious in its definition, but it's important to understand. So an offset account is a fully functional savings account which is linked to your home loan. The benefit of the offset account is it provides the credit interest on savings in the account at the same rate that is applicable to your home loan. So effectively offsetting the interest that would normally be charged on this portion of the loan. Unlike a redraw, the funds that are in the offset account are available to you 24/7, so you can use it like a normal savings account. And the main benefit obviously is that funds that you would normally have sitting in your savings account are helping you to reduce the interest that you would normally pay on your loan. So it's a great thing to think about, a good product add-on and something to talk to your financier about. So once the product decisions have been thought through and the borrower will opt to choose the best option which suits them, we want to get back to our case study and have a look at what those numbers actually mean. So if we're looking at the purchase of $800,000 again, we're looking at a loan at 90%, so that's $720,000. The repayments on that over a 30-year loan period on a P&I basis at a rate of 2.4 will be $2,807 per month. So as a comparison for what people are currently paying, that's $647,000 per week. So what that does is give you a good comparison if you're a rent payer at the moment as to how much more you may be paying, or in this low rate environment, you may be basically on par. And if it's over and above what you're paying at the moment, how much more you need to save to be able to make those payments comfortably on a property you're looking at purchasing. So as you can see, there's a lot to consider in the numbers in the product. However, in this low rate environment, we feel that there's a really good opportunity for medical professionals to get into the market. I think that's all we need to go through. So back to you, Lewis.
Thanks, Paul, and thanks, Lindsay. Really informative and great for you both to share the wealth of knowledge that you have. It's now time to go over some of those questions that have been trickling in over the last 20 minutes. And if you've still got one to ask, now would be the time just to drop that into the Q&A box there. We might go to Lindsay first of all. Lindsay, we've got a question here. If I am newly self-employed, can I still apply for a home loan?
Yeah, great question. We did touch on the difference of employment structures from a salaried PAYG person to a self-employed person. The answer to that question realistically is maybe. It depends on how long you've been self-employed for, because we do need to evidence that income in a reliable way. Most banks typically want to see 2 years of tax returns for people who are self-employed to prove their regular ongoing income. However, for medical professionals, 1 year is often only required for some banks, but other banks we can evidence your income over a shorter period of time, so 6 months, and in some extreme cases maybe even only 3 months. So it depends on where your transition of income comes from, where you were working previously, and what your new income looks like and how we can evidence that. So I suppose it's not a great answer because it's maybe, but definitely chat to one of us about that if you are in that transition period, and we can talk you through what that looks like and how to get the best outcome for you if you're really serious about buying a home.
Thank you, Lindsay. We might jump back to Paul for the next one. Paul, can you lend on units in developments where there are lots of units? And if so, what borrowing level?
Yeah, thanks, Lewis. I think the short answer is yes. We can look to lend, or most banks will look to lend up to 90% on those units in most cases. But you're right in raising the fact that there's a lot of noise around high density areas that have got a lot of units. So I would check with the financier first on two fronts, I suppose. The first being, if there is a lot of those units, banks may have a lot of exposure in terms of how much they lend on those particular blocks. So they may have a register on places that they'll have a maximum exposure to, so they may not lend on all high density units. And the second thing, if you're looking at some of the newer units, they're quite small, say under 50 square metres. It's also another thing to raise, just to make sure that the bank will actually go to those borrowing levels at 90% on a unit that's a little bit smaller. Recently in the market, we've had a few developments in some of the areas in a few states where there's been some dodgy building and some cracking and moving on particular blocks, and in most cases those banks won't lend on those properties as well. So if you know there's anything adverse to do with the property, raise that. And yeah, but the short answer is yes, we can certainly consider lending to those levels or to those higher levels on those units.
Thank you, Paul. That's probably something you see a bit more of down in Sydney and Melbourne compared to up here in Brisbane. Lindsay, I have another question for you. How do I know if I qualify for a stamp duty exemption?
So stamp duty is state by state, as we talked about a little bit there, and the exemptions apply for first home buyers are different based on where you're buying and how much you're buying for. So best to either, essentially there's a couple of places you can look. You can either talk to your finance provider, so about what you're looking for and what the requirements are to qualify in your state. A conveyancer can often help you with that question as well, or your state revenue office to have a look at what the actual exemptions are wherever you're buying. So a couple of resources there, but we'd be happy to talk you through that as well as to how you know if you're going to qualify for that or not.
Thank you, Lindsay. And Paul, you've told us about units. Now, as a first home buyer, can I buy land and build a home?
Yeah, thanks, Lewis. Yeah, you can. And I think under those same sort of lending parameters, the banks will consider lending up to those higher borrowing ratios on land and construction. So we can certainly look at that as a first home buyer. The one thing to keep in mind is if you are looking at some of those benefits and those incentive schemes that the government have around new builds or land purchases, you just want to check when those schemes or the cash that you receive from those actually kick in, so that you're not caught short on settlement if they don't arrive at the specific time that you need them to settle on the land or start the construction. But the long and the short of it is, yes, we can certainly look at construction loans, land and constructions for new builds, and the government does incentivise under their current schemes for both of those.
Thank you, Paul. We've got one more question just to wrap things up that's just come through. I might jump on this one myself. Someone's asking what happens to interest rates if the cash rate hits zero. Well, it's something that people are predicting will possibly happen in November or December of this year if the Reserve Bank decides to cut interest rates further to try and stimulate the economy. Generally speaking, banks don't borrow money directly from the Reserve Bank. It's more of a benchmark as to what's happening in the rest of the market. So I wouldn't expect to get an immediate reduction in your interest rates. But the banks do generally follow what the Reserve Bank does. So if they do decide to cut interest rates to zero, what you'll find is that anybody who has a savings account, their interest rate will reduce, and anyone who has a home loan or mortgage, their interest rate will probably reduce as well. But it might not be exactly in line with the Reserve Bank. It does tend to vary from bank to bank. So definitely, if you see that happening in the news in the next couple of months, then it's a good time to phone up your bank and review everything with them. Right, I think we'll finish the questions there, and that brings us to the end of today's webinar. So thank you all so much for your time today. We hope we've helped you to make sense of what you need to consider before getting started in your home search. Since buying your home is different for everybody, we invite you to reach out to us for a more personal conversation with one of Credible's lending specialists. Our team has a lot of experience in helping medical professionals finance their homes and investment properties. And as you've seen today, we're always happy to share our knowledge and experience. If you do want to chat about your specific situation, or if you have any questions, you still have a few moments to leave your details in the Q&A section and someone can get back to you. If you do go onto our website, you can live chat with us, you can leave us an inquiry, or you'll actually find all of our direct mobile numbers if you want to give us a call. Lindsay and Paul, thank you again. Great chatting with you today. For all of you that have registered to watch us live, keep an eye on your inbox as we'll send you our Home Buyers Checklist ebook for you to refer back to. And if you'd like to stream any of our previous conversations, then we have a growing library of fantastic content for you. They're all on the website now, where all of our blogs live. We hope you enjoyed the conversation and stay tuned for our next webinar. Have a great rest of the week and see you all soon.